on with Isaac LaFawn and Eric Douglas. What's going on, fellas?
Good morning. Morning.
Yeah, no. So this is morning time on the last day of June June of 2020. And for the record, as long as the market doesn't fall off crazy today, this will be the largest gain of the market in any quarter in history. Isn't that amazing?
It's crazy. It's amazing to think back when we were looking at what the market was doing at the end of March, to think that we would only be at this point down less than 5% on the S&P for the year. Midway through the year, it's unbelievable. I can't believe it. We'll take it.
Yeah, but
I'm not complaining. Yeah.
But if you look at what's happened during the second quarter of 2020, and to think that it's been the largest quarter gain on record, it just the two don't go together.
What's driving it? Yeah,
the two just don't go together. There's something weird. Now, we did have kind of a quick snap pullback, the last part of March of the first quarter, but there's a disconnect between where the market is and what's happened over the market. There is. But with that being said, we're not talking about that today. Maybe that's another day, another topic for another day. What we're talking about today is really a follow-up from last week. So if you didn't catch last week, make sure you jump back on our podcast channel or our YouTube channel and catch last week's episode. And this week is really a follow-up to last week. Last week we talked about certain myths in retirement that I think we all sort of agree we don't necessarily buy into. And so we wanted to sort of translate that into this week, which is, we're titling it sort of, what is your retirement number? And this show's really come about. This was a radio show we did probably a year or so ago. And it came about because, if you guys can remember, we were chatting about this before we jumped onto this podcast. I'm going to say maybe 10, 15 years ago, something like that.
Give or take.
Yeah. ING, which was a fund provider and an insurance company, they came out with a really cute commercial. And it was about what was your number. If you guys remember it, it was a bunch of people walking around a neighborhood, and they were carrying signs, or looked like, I guess they were signs, but essentially they were numbers. And one was like 678,000, and one was like 1.2 million. The other one had another number. There was one guy in particular that was carrying around a sign that said bazillion. And the point behind the commercial, which was really cute, was that guy had no idea what his retirement number should be, essentially saying he didn't know how much he needed to have accumulated throughout his lifetime in order to retire. That was the point behind the commercial, right? And so we thought we'd do a radio show on it, and we just started talking about what is your retirement number, and we have a little bit different spin on it, or at least I do, and so I wanted to get your all's thoughts on that as well, and we thought we would just debate today, what is your retirement number, and what are the conversations we have with clients around, when they say, hey, what's your retirement number, what's your retirement goal? So, Isaac, I'm going to come to you first. Client comes in, our prospective client comes in, and they're talking about retirement. What are some of the conversations that you have with clients when they talk about this retirement number, meaning how much they need to have accumulated by the point they retire? Is that the number you're talking about, or is it something else?
Yeah, I think I'll go back to one of the things I said last episode around, basically it's kind of like, what have you done to this point? What's like your lifestyle been like? We have a lot of lifestyle conversations. What's your life like now? What do you want it to be later? Because to your point, just to have a number, well, what's the purpose of that number? And so I think I want to like kind of reverse engineer things and break them apart, and then put it back together, and then actually see if what they have or what they're going to have makes sense, right? It's like how do you need to like position your assets? How do you need to structure your assets to actually make what you want to happen, and then start talking about legacy. And that, I think legacy is one of those conversations that they've never put a pin in, right? They've never really started to kind of think about that, right? They'll say, yeah, I want to leave some stuff to my kids. Well, how do you want to leave it to your kids or to your church or to your charity? Do you want it to come to them in lump sum? Do you want to give it away to them over time? When you're gone, would you like it to be like you were still here, where you're leaving some money on a regular basis via a trust or something like that? So we kind of, once you start putting those pieces together and get a feel for what makes sense, then you can arrive at a number, I guess. But that's rarely where we look at them. I mean, almost never do we get to the end of planning. We're talking about the number at the end of their life or the number at 80. It's not that isn't really how things work. It's more they're happy if they feel like they can achieve the lifestyle and the goals that they talked about.
So would you agree that when most prospective clients come to see us, and Eric, jump in here too, don't you kind of get a sense that when they first come in here, sort of the way they view things is almost backwards to where we go with things?
Yeah, I think that's why goal-based planning has become like such a big thing, especially in financial planning.
Right.
Is it is goal-oriented? I think, here at our firm, I think we do a good job of taking that a step further and still applying like cash flow planning that's, a little more intuitive, a little more work than just simply plopping a goal and seeing if it's viable.
Right.
And cash flow planning forces you to actually line stuff out, kind of show your work, so to speak, which I think helps clients really see that kind of stuff. How is it actually going to happen? Makes a big difference. But yeah, I think goal-based planning ultimately helps get traction a lot quicker than numbers, because when they can start seeing what they're trying to do and then understanding what's possible and not possible, then I think they feel more confident.
Yeah, I really don't spend that much time at all talking about any type of a specific retirement number, right? That's not really something that ever comes up. We spent a lot of time in the last show talking about what's your rate of return. And I think I'd mentioned people don't spend percentages, they spend dollars. They're much more focused on the dollars that they have available to spend. It's the same thing here. I don't think it's necessarily this mythical number that I ever really talk about. More or less when, by the time they come in to see us, I mean, their lifestyles are generally fixed. They're making the amount of money that they're making, depending upon where they're at in their life. But if someone comes in at the age of 55, they have what they have. Maybe they have another 10 years to work, and we can change some things around the edges, but it's not like they're going to start being able to accumulate an additional $100,000 a year potentially that they don't already have, right? So we need to take the number that they've already got and figure out a way to maximize it and make sure that they're reaching their goals. And this is kind of getting into what we're going to talk about a lot, throughout this episode is risk. How much more risk do we need to take within your current portfolio to achieve what you want to achieve? And going back to what you just said, Isaac, about goal-based planning, it's very much understanding what are the goals that you have for your income, for your retirement, and how best can we optimize what you do have to be able to reach those goals.
Yep.
Yeah, so here's I was telling you guys the story. I have, over the years, have had prospective clients that have come in that'll say, when you first come in, we walk through the same questions. What are you looking to accomplish? What questions do you have? What may keep you up at night? What concerns you about money? Just basic common questions. And ultimately, we get down to, what things look like in retirement. What do you want to see when you get to retirement? And we talk about, just assets. And the first thing they do, which is contrary to what you had mentioned, we look at all this goal-based planning, and clients want to go right back to, I've got to accumulate a certain amount of assets. So we had, I've got this one client. He's a client now, but he was a prospective client at the time. Comes in and just says, I need $2 million. And I was like, where did you come up with that number? That's the number I need. I need $2 million to retire.
In fairness, Brian, we all need $2 million, right?
No, that's true. That's true. So, but it was funny. He just kept saying, I need $2 million. Like, I need to accumulate $2 million. And so I wrote that down in my notes. I just made a note of it. And I didn't address it at that point because, we like to do that throughout the planning process and show them that it's not about accumulating a certain dollar amount, which is the topic of this conversation today. What's your retirement number? It's about another, it's about goal-based planning, or you're going to be successful, accomplishing certain goals or whatever. So during the cash flow process, he listed for me like all of his expenses. And you guys, we talk about this all the time. We're all kind of numbers guys, right? So I know he's got he wants $2 million. He throws this number out at me that he spends every month. And I was like, bells go off, right? And I'm like, dude, you can't, for what you spend every month and what you want to spend in retirement, you wouldn't even spend the interest on $2 million. Why is this $2 million such a number? And it may have just been like an emotional number to him. Hey, I know if I hit $2 million, I'd feel good about myself, or, I feel like I've, accomplished something in life, or whatever it was. But again, it's just funny, the perception of investors, that they're more worried about the amount of assets they accumulate than really, I think, which is the most important number, which is the point that I want to talk about, which is the conversation we have around what's the probability of your retirement being successful. To me, that's the number, right? And that's the number we come up with when we do financial planning is, let's look at the probability of success. So we'll look at all your income. We'll look at all your outflows between, the day you walk in the door with us until the day you pass away. Unfortunately, we can't let you live forever. So it's always kind of funny. I always say, in this planning process, guess what we get to do? And they go, what? And I go, we get to kill you. And they're like, what are you talking about? And I'm like, well,
It's called end of plan, Brian.
that's right.
End of plan.
Yeah, that's right. So, well, we get to kill you off in here. And then I always look at the woman or the female, and that's usually in the group, and I go, well, we let you live a couple years longer. It's pretty funny. They get a kick out of that. But statistics will show that a female will live a little bit longer. But anyway, with that being said, that's really, I think, what the most important piece of that clients should be looking at is, what is the probability that what I have accumulated over the course of my life will provide me the lifestyle that I want from now and in the time.
Yeah, I mean, to kind of go back to like your client that had this 2 million number, and we've all had these conversations. They come in and they're like, because it's been a savings goal only, right? And to Eric's point, they've have a lifestyle. They kind of have this fixed pattern, and to their credit, they've identified, well, I just don't need this. I'm just going to save it. That's what I'm supposed to do. Because when they get on their 401k review call every year, they tell them, if you go from 11% to 13%, these are good things happening,
right?
And you'll have this or whatever. And it makes it very, viable. And so they know that. But then when you start actually asking them to start putting it together, I can't tell you how many times I've had to tell people you have to spend more money.
Right.
Either pick like a really good charitable cause,
right,
or teach your kids how to be smart, or where you get comfortable leaving the money, or you need to start spending, remodel your kitchen. You have to do something. This money is going to be here. I'm telling you. You're going to get to the end of your life, and it's just going to be there. And it'll be unfortunate that you didn't, to your credit, you saved all of it.
But you didn't enjoy your money while you had it.
Yeah.
Right.
Yeah. And you mentioned on the last podcast, the lady crying because she realized she could live her life a little bit even before retirement. Your best years, like the next 5 years, are likely to be your best and healthiest years. Right. Enjoy them and think about that stuff.
Well, it's funny. So we had a client come in that came in to do some financial planning earlier this year, sitting on about, between her and her husband, $2.5–3 million in their IRA accounts, savings. I mean, the guy was an engineer, right? Yeah. He was did a fantastic, an absolutely wonderful job of saving up throughout his career. He actually retired at the age of 60. So did his wife. He was actually 66. He still had not turned on Social Security. Neither had his wife.
Yeah.
They weren't even drawing on their assets because he had a pension from his previous job. And his question was, and he had no debt, mortgage was paid off, and he was basically living on about $65,000–$70,000 a year. His pension almost covered all of that, so he was only withdrawing about $5,000 to $10,000 a year, and he was trying to figure out when the best time to turn on Social Security was. And I said, well, at this point, it really doesn't matter, because when you turn 72, you're sitting on a tax bomb with your IRAs that you're going to have to start drawing down from. And it was income that he did not need it, and we spent more of the conversation doing exactly what you just said. What do you want to spend this money on? What are your goals? Do you have any charity? There's things that they had never thought about before.
Yeah.
Because you have the ability to do some things with your life and with your money that can have an effect well beyond, after you're here. And the other thing too is they had not chatted with their son. They had very direct focus about wanting to leave a lot of money to their son. But when I showed them the projections of, okay, this is what your portfolio could be in 20, 25 years, is your son equipped to be able to handle receiving this amount of money? Long story short, he wasn't, and that was something that they had not talked about. So
also maybe involve him in the conversation.
So those discussions are ongoing, but yeah, it's helping people realize that this isn't necessarily just about trying to figure out whether or not you're going to outlive your money or how to make your retirement more successful. It's being able to do things that you never thought you might be able to do, and how can we help accomplish those?
Mm-hmm. Yeah, so this is interesting. So we just a few minutes ago I mentioned this kind of probability, And we get lots of questions when we talk about, when a prospective client comes in and we sit down and we start talking about, maybe a number comes up, or we're talking about, financial planning and cash flow planning and how we view it. We talk about probability a lot. And we talk about probability because there is no guarantee, there's no certainty beyond right now. And so we don't know what's going to happen. We know the market is not going to ever be the same day after day, right? It's going to be all over the place. We know that asset values are going to increase and decrease over time, depending on what your savings rate are, depending on what your spending rate is, like the gentleman you just talked about. But there is in the planning world, there is a program that we can run that looks at your inflows and outflows, and it even looks at things like how often you buy a car, and do you finance it? Do you pay cash for that? Do you have a wedding you need to pay for? What does downsizing your house look like when you're 70? There's all these different factors that happen throughout your lifetime, and what we're really trying to do is determine whether all that can actually happen. And so when you look at the probability of whether that can actually happen, what we're looking at is a simple formula. Now, this planning software we have is very complicated. And we're actually implementing newer software that's not so complicated, but we do have very complicated software. Clients don't need to know anything about it other than, that we know how to use the software. But in a nutshell, what it does, it says, okay, you have a certain amount of expenses that you're going to live, or that you're accustomed to spending every month. Let's just say that number for this example is $5,000 a month, right? So that's what somebody needs every month to sustain their lifestyle throughout retirement. It's $5,000 a month. Now, we know that increases with inflation, but for sake of conversation, it's $5,000. So first thing we're going to look at is what are the permanent, predictable income sources that client has. We talked about pensions, Social Security, annuity, payments from an annuity. Those are what we call permanent, predictable income, which means we know it's coming in. It comes in every month or however you select it. Sometimes annuities can pay annually, but we like consistency. We talk about that all the time. So let's say we have income that comes in every single month. We time it to where it comes in. It represents your normal pay schedule while you're working, so there's no disruption in that. And then anything beyond that is the unpredictable income source. So when we look at the big picture, we say, okay, let's say that $5,000 is what you need, and the permanent predictable income, let's say, is $3,000 a month. So really all we got to do is cover this $2,000 a month. So you've got all this money you've saved up, like the IRAs you mentioned a minute ago. You got Roth IRAs, you have after-tax money, maybe you have invested in real estate. Whatever the case is, all that accumulation of wealth has to cover $2,000 a month plus inflation. That's it, right? And it's what is the probability that your accumulated assets can provide you $2,000 a month plus plus inflation over the course of your lifetime. That's the probability. And all we're doing is solving the puzzle to say, is that a high probability that your accumulated assets can do that? That's the probability number. And I guess that's the point behind the show, is that when we talk about what's your retirement number, in my view, it's not necessarily about the amount of money that you've accumulated. I don't think that's it, because you can accumulate, the guy that was walking around with the $600,000 or $1.2 million or whatever in that commercial. What you don't see in that commercial is the amount of permanent, predictable income that particular person has. Some people are just going to have Social Security and that's it, right? Some people have pensions, like you were talking about. Other people have put annuities in place that in 10 years are going to wind up paying them, a personal pension. Some people don't have that. So if you had Social Security and a pension and the annuity income, you don't have to have this gigantic accumulated source of other assets to, fulfill your lifestyle income. You just don't need that. So that's the point behind the show is, hey, let's solve for what is your probability number more so than what is the total accumulated assets you need at retirement. What are your all's thoughts on that?
Yeah, I think that I remember one of the first meetings I sat in with you, Brian. I thought you had two really good pieces of language that kind of boiled down a little bit of what we do. One is like our first job when we're meeting a client is to listen, ask a lot of questions, figure out those things, the lifestyle things, all, with the kids, how does it factor in, all the things that Eric talked about too. But ultimately, like the first blush of a financial plan is an audit. That's basically what it is you're kind of downloading everything, running some analysis, understanding what they're trying to do. And the first job is to go into the software and basically come back and say, run that stress test, which is another piece of language you use. So those two things, an audit and a stress test, and say, how viable is this and where do we need to start tweaking? Mm-hmm. Sometimes it's telling them, you're going to have to find ways to spend money or get very charitable or something, right? I remember the first time I recommended somebody, they were really big into lake doing stuff with the lake and all that. I'm like, well, you can permanently fund, you can buy a resort house, permanently fund it for the rest of your family, for the rest of everybody's lives, perpetually funded. And they were like, what? I'm like, you don't spend anything. So you're not going to. You're 85. Right. It's not happening. Right. You're not going to take up yachting anytime soon. It's just you're going to need to do something, and your kids are telling you they don't. We got their kids involved in all that. But to your point, I think it's the audit, the stress tests, come back with the viability. And the other thing I remember in one of those meetings with you too is that being a younger person, I think what's really cool about our firm is there's different ages and different experiences. And being a younger person and newer in the industry, you think more about, sometimes you get too concerned about return and that. And really our job is to maintain viability, right? And sometimes that means we might make a little less or something, but that was intentional because that's what the directive dictated, is that if we're going to do this, we always protect this viability, because the difference in, 7.4 million at the end of your life and 7.1 million at the end of your life is not something to potentially wreck the viability over, right? And I think people sometimes, because saving, to our last conversation, is different than unwinding that savings and utilizing it, are two different things.
Well, it's going from an accumulation mindset to a decumulation mindset, and it's a completely different point of view that it's a switch that you have to make in your mind, and you spend a lifetime accumulating assets and trying to grow those assets to the greatest degree that you possibly can. When you switch to a retirement income or a decumulation strategy, we want to make sure that we get you where you need to go with the least amount of risk possible. Mm-hmm. Because the greater the amount of risk in your portfolio, that just increases the chances for something to go wrong. Mm-hmm. And that is the absolute last thing that we want to have happen when you're no longer, you don't have that earned income any longer, right? Yeah. You're no longer working, and you don't have as much of that predictable guaranteed income, or I don't want to say guaranteed, but the predictable income that you're regularly experiencing throughout your lifetime. So
yeah. So the other point that you bring up, which is Isaac, that's really interesting, is we do from time to time have prospective clients that come in, and we start working with them, or they have worked with a previous advisor. It's more so when they've worked with a previous advisor, they come in and they are so focused on rate of return and what am I getting, that they lose sight of the bigger picture, right? Mm-hmm. And I think it still is very true when it comes to what we're having a conversation today, is kind of this probability number, because I think that's the most important thing, is this probability number. It's not the accumulation of assets, as we said. So to your point that you were just making a minute ago about this rate of return, that I think sometimes people get affixed to it, and they'll say, well, I'm 50 years old, I should be, 60, 70% of my assets should be in stocks, which means I should have a 7% rate of return. That has nothing to do with it at all. No. Because if you're 60 years old and you spend $5,000 a month and that is your lifestyle, and you've already accumulated $1.5 million in various accounts, whatever, you're going to have plenty of money. You're never going to run out of money with that particular lifestyle. Now, that's not to say something weird wouldn't come up and kind of a financial issue between in a family. That's regardless of that. But point being that we have had clients that have come in, again, around this general conversation of what you ultimately need to have accumulated, and we run the numbers, and let's say they'll have a fair number of permanent, predictable income sources in retirement. They've already, the great savers, like you mentioned a minute ago, your client, and we tell them, okay, your investment number, okay, or your risk number, which we're talking about numbers, is, let's say, a 25 out of 100, right? We have software that if you want to know what that is, come see us or check out our website, and you can do your own evaluation and see what your number is. But the interesting thing is when we tell them, hey, you're at a 70 right now, and your plan says you could be at a 20 and still be more than successful, they almost can't even believe that those numbers are accurate, right? So you have to keep running it to say, no, we have this run as a 20 or 25 or whatever, because you've done a great job of saving. At the same time, the opposite can be true as well, right? We have somebody come in that's scared to death of the market, and they're not going to be successful in their plan. Like, well, you have to make other adjustments, right? Because if you're scared of the market and you're not willing to expose your assets to risk, which means a potential higher rate of return, you're gonna have to make some adjustments to make your plan work, right? So I think the point behind that I bring in addition to this is, if you are an investor and you've really never worked with an advisor, or you're working with an advisor that is so focused on rate of return, or you're looking at that ING commercial and you're going, wow, my number's 1 or 2 million, like the case I said, just come and see us and we'll show you a completely different view on how we see this number game. And it's a probability number, and it's a real rate of return number. Do you guys agree with that?
No, yeah, absolutely. And especially if you're working with an advisor who is much more singularly focused on that rate of return, on performance, if you will, over time, in order to keep up with that, you're going to have to take unnecessary risk in a portfolio that maybe you don't need to be taking with your assets. Maybe you're already there. Your probability number looks really good. We can get you on a path to optimize your retirement income strategy, and you're going to be fine. You don't need to be taking on too much unnecessary risk. Someone who's much more focused on that rate of return could be placing you in a position where your assets are in a riskier spot than they need to be. And that number that you had, maybe whatever it was, 1.5, 2 million, whatever the number may be that you thought that you had saved up, well, if you put them in a riskier position, that can decrease really, really quickly when you're in a decumulation strategy, when you're drawing down on your assets in retirements. And so, that's the type of unnecessary risk that we want to make sure that we are eliminating from your portfolio to ensure that probability number stays high.
Yeah, I mean, I think ultimately a lot of the confusion and diversion, like that's what you're identifying, Brian, is this diversion away from what actually is the subject matter, is because that's what the commercials say, right? There's only two camps that are running ads, right? And they're either saying we're gonna get you more than the next guy, right? Or trade in this mutual fund for that one, right? And then there's the other camp running ads that are basically like, that's all trash. You just need certainty, right? And there's nobody really in there. So, and the number of families typically they only really interact with 2 or 3 financial professionals throughout their whole life.
Right.
And so they have low exposure. A lot of it's siloed conversation. And then the odds are they may not run into a financial professional in their lifetime that gives them a lot of clarity, right?
Mm-hmm.
Because
most of them are very transactional based.
Yeah, very transactional. And all the things that we're talking about take a lot more time.
They do. To
have that conversation, build that relationship with a family versus, taking a shorter path that's a lot easier. But, going through this time, even though, to your point at the beginning, Brian, this is somehow the second quarter with all the good news that we've been faced with in our society. The market has somehow had an amazing second quarter. Peace of mind, I think, is ultimately, and it's appropriately the podcast is named this, peace of mind. Ultimately, our goal is to, even during turbulent times, to not have families worried about these things, because they appreciate that we ran the stress test, we've determined viability, and they believe it. Because they were involved in the discussion, they were involved in the decisions, and we showed our work. And that's how you do it.
Yeah, so it's interesting, and being a financial advisor, you run across a lot of advisors across the city and even across the country for that matter, and pretty much who are the transactional guys and who are the guys that actually do good, solid financial planning. And it's interesting, and we have people that we connect with that are there to support us. We had one on our radio show several years ago that's we go to about life insurance. We had one that we go to about annuities, and they're there really just to provide us just a platform that we can go to provide a solution to our clients. And so it's interesting. You can tell those advisors actually do good, solid financial planning, because when you talk to them, especially over really since March, right, markets have been crazy. We've had a quick snap drawback, and then we had a quick rebound, and who knows where the market's going. But you talk to those advisors, and just like us, our clients still call and ask questions. Hey, what's going on? Give me some information. And we're all very good about making sure we're constantly updating clients. We send out either weekly or every other week, either some kind of newsletter or an update, just to keep our clients informed. Hey, this is what we're doing. This is what we're thinking. And we really don't get that many calls. I mean, we get a few, but not that many. And then you talk to the guys that are very transactionally based, and you talk to these our providers, and they call us, and we're talking to them, and we're like, hey, she's like, hey, how are things? Like, no, it's fine. Things are good. And she'll go, well, that's not what I'm hearing with other guys. I'm like, because they're very transactional based, and or they're very focused on a singular source, as you were talking about, which is a rate of return. And it's like there are so many advisors just live and die by their portfolio and their rate of return that during turbulent times, it's a lot more stress on the client and the advisor. But then to your point, they have to start making chances and taking chances in the portfolio to gain back what they missed out on by taking chances. And so I just don't, I mean, our team just doesn't believe in that. We believe in good, solid financial planning and having that kind of peace of mind that when things like this happen, we've assured clients, we don't know what's going to happen. But what we do know is history will repeat itself as it's always done, and the markets will come back, right? I don't know when they'll come back, and who knows if we're going to have another pullback in the market. I don't have any idea. But our clients know that we put things in place, we've accounted for things like this, and they're going to be fine.
Yeah. We had a client, we finished their first kind of edition of a plan. They referred to us in the fall. We finished it in February. So they were planning on retiring in the summer. So like April, I get this email and it's like, hey, we need to meet, make sure I can still retire. And I was like, you remember that stress test thing?
Right.
It really doesn't matter if the stress test happens now or it happened in 10 years. That scenario was ran out.
Yep.
Yes. So they were like, well, we need to have a couple meetings. And after the first meeting, it was like, okay, I don't, And I was like, oh, we're happy to talk through it anytime,
Right.
But it is like, the more, it's all about the relationship. And by the way, part of the reason we believe in that is for us to do a good job and feel confident, because it's a heavy burden to have someone work their whole life and to trust you to like put that together for them. And like, actually, if you really think about it, what you're offering and what you're trying to do is a pretty heavy hurdle to cross. And part of the reason I think all of us, kind of require that relationship from our clients, and the reason we've gone down that path is it's more viable for us, I think, to actually recommend that. Because then it's our ability to recommend good, solid things, to know what things you might come across or think about, helps us do a better job. So, there's transactional advisors, and sometimes that's what clients want. So they have a place because the clients, that's easier.
Yep.
And so, what we do is not for everybody, but people that want a relationship, it works out really well.
Well, that's why we talk about doing financial planning. And you talk about this a lot, Brian. Mm-hmm. It's one thing to put together a financial plan and, say thanks for coming and we'll see you later. That's not what we do. We do ongoing financial planning. We are regularly meeting with our clients several times a year and updating the plan as necessary. If we need to make changes during like the first half of the year that we've had, for example, this year we certainly can, but it's an ongoing process and it's ever changing. And that's why we talk about planning versus just putting together a basic financial plan.
Yeah, maybe that'll be the lead into the next show, because that's a good one because there are, I think sometimes clients that are out there, we're going to wrap up today's show, but there is a difference between getting a financial plan done, which is a snapshot in time, which a lot of advisors will do that, and there's a reason they do it. It's because they're trying to identify all the assets that you have. That's the only reason why they do it. They don't charge you for it, and so they'll say, yeah, it's free. Well, because all they're doing is getting a list of your statements, trying to find out where your assets are, versus what we do, which is financial planning, which we're looking at full balance sheet focused. We're looking at risk. We're looking at estate planning. And it's a lot of time. That's why we charge for it, because it is not a free service. And you get, it's that old saying, you get out of something what you put into it. Yep. And if you pay nothing for it, you're likely going to get something that's not of high quality. Well, anyway, with that being said, maybe that's next week's show. We'll make a note of that. But just to kind of wrap up this week's show, this is all about what's your retirement number. And just keep in mind, if you get nothing else out of this, pick up the phone, call us, come see us, and say, hey, I I've always thought my retirement number was $1 million. I always thought my retirement number was, I had to get a 7% average annualized rate of return. Let us show you what your real number really should be, which is what's the probability of your retirement success. And we've got those numbers. We can do that for you. So give us a call. You got the number in our email right up here. We don't charge for a first meeting. So you can come in and kind of pick our brain and find out what we're all about, meet the whole team. We're all right here together in St. Matthews. Or you can call us on the phone. We can all do a webinar or a GoToMeeting or a Zoom or whatever you want to do. We've got all those capabilities. If you want us to wear a mask, we'll do that too. But anyway, it's like 7 million degrees in this room because our air conditioning's out right now. So apologize for the sweat and the glaze on the face there if you're watching this on YouTube. But we're going to cut this short and get out of here and go outside where it's cooler, I guess. But we will see you guys next week. And Eric, wrap up with the whole share with all that stuff.
Well, thanks for listening. Listen, subscribe, rate, and review. We appreciate it.
Everybody have a good one.
Given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.